I do always like to start off the show with a summary for what I saw in the market this week that I think is important. So, obviously, the big story this week, really at the beginning of the week, especially, was about the debt ceiling. So, the US government is required to basically go and ask Congress to increase the debt ceiling so they can continue to pay the bills. It's become a little bit of a political football, and it's a really big deal for all of the things that might happen in politics that affect the stock market. Really, the debt ceiling to me is probably the number one piece. So when they're starting to, get close to the edge of not being able to pay their bills because they haven't raised the debt ceiling, that's a time to get pretty cautious. And we did over the last 3 weeks. We've been pulling money out of the stock market and just kind of parking it and waiting to see what would happen. The projections are that the market could drop 30 to 40% if they didn't, raise the debt ceiling and we did default. And so that's not something we really want to be involved in. But come Wednesday, finally, there was a resolution that started and eventually was approved on Thursday to allow for a short-term increase in the debt ceiling to get us through to the beginning of December. So again, this is still something we're going to be dealing with. That's not that far away, but hopefully there's enough time in there for things to get organized and some more negotiations to happen so that they can raise it really probably past the midterms, like December of 2022 would be the ideal situation. So that's what's happening right now in that area. Because they did this resolution, we moved back in to the market on Thursday with the assets that we pulled out. That worked out great. For the most part, the market was down lower when we got back in than when we got out. So I like that portion. I don't normally do that, but it is one of these things that is very important to pay attention to and make sure that that works out right. Today, we had a very interesting report that came out, and it had to do with the number of jobs that were created for last month, for the month of September. So the expectation was that we'd have 500,000 new jobs created. Well, it was only 194,000 new jobs. And so that's 2 months in a row that we've had low job growth. The month before that was 235,000 new jobs. And so this is a very fascinating and very, very different scenario. Usually, when we are looking at lower jobs opened than expected, it's because the economy is starting to erode and fall apart. And so that's what we're looking at. This is not what's happening here. The economy actually, on a demand side, in terms of sales and revenue, is growing quite rapidly, but people aren't taking the jobs. There's 11 million roughly open jobs, which is the most in history, and roughly 8 million people are unemployed. And so that theoretically that should match up, and we should have probably 1 million jobs created every month, but they're not taking the jobs. And so at one point the thought was, well, they're not taking the jobs because of the extra unemployment insurance. Well, that ended. They're still not taking the jobs. And then there was another thought that maybe they're not taking the jobs because of school. So somebody has to stay home until school starts. Well, school started, still not taking the jobs. And so it leaves a couple of different areas, which are very fascinating. Number one is via survey, the number one reason that people aren't taking jobs is because their fear of catching the virus, which is somewhat legitimate. Obviously, we had a spike coming up with the Delta variant, and a lot of the jobs that are open are jobs that were closed because of the exposure to the virus. So that's something we'll have to see how that plays out. The Delta variant is trending downward now, so maybe that improves as that gets better and people get more confident and start taking those jobs. But the other area is really interesting. I'm reading more and more articles about how there's some potential systemic changes that are happening in the labor market. So essentially what happens when schools closed, all of a sudden one parent started staying home, and the households have restructured around that. Some of them even moved to cheaper places. And there's a thought process there that that might continue. Maybe there will just be one wage earner in a lot of these homes going forward, and one will stay home and take care of the kids after school and what have you too. So that's kind of fascinating to see what happens there. Then you've seen a whole lot of early retirement. So somebody who's going to retire in a year or 2 years or 3 years, they're retiring now. And so that's kind of pulling back in terms of the jobs. And then the other thing is just kind of people going after alternative types of employment. So instead of working at Starbucks, they're getting on YouTube and opening up YouTube channels, or doing things on Fiverr, or all these different, what we call kind of a gig economy jobs, and really starting their own businesses instead of, trying to rely upon these other businesses. So very, very fascinating. But here's what that means to companies and ultimately to the stock market. If you have a company that relies upon people to generate your revenue, which most do, and your revenues are going up, so people are coming in more and more, but you can't hire new people, you can't sell those revenues. So in other words, if you had an order for 1,000, widgets and you can't hire enough people and you can only sell 100, that's going to reduce your revenues, especially what you could have made. So, for example, if I have a restaurant, a fast food restaurant, and I can't get new employees, I might only be able to open up my drive-through window and not obviously the people that are, inside. The other portion that's kind of slowing things down has to do with the supply chains. And we've talked about this, but I have a friend in Southern California, sells trucks and cars, a dealership, very successful dealership, usually has 600 to 700 cars. Right now, they only have 5 cars on the lot because they can't get semiconductors to build these cars. So this is a very fascinating thing. This is not a normal scenario. Usually when we see reducing revenues or revenues coming in under expectation is because there is a demand that's dropping off. Well, the demand is still there. It's still coming in, but we can't get the supply. We can't get the people into the restaurants, for example. We can't get the cars into the lot to sell them. And so that's one of the very fascinating things to watch and see how that plays out as far as that goes. Now, those are the things that are going to be kind of weighing on the market here because what we've got is a scenario where the expectations for growth in the third and fourth quarter were really high, and rightfully so. Things are reopening, going really well. But if we can't deliver the products to sell, we're going to have some adjustments. And so a lot of these earnings calls that are coming out now, they're talking about not being able to get enough supply to do this or that. And they're going to, come in with some smaller numbers than were expected. And so the market is going to adjust for that. And that's what we've been seeing altogether. The market looks forward and it says, okay, they're not going to be making as much as we thought. Now, they're still phenomenal earnings. They're just not going to be as great as expected. And so that has to be an adjustment in the market. But here's my key takeaway, and the thing that I find very fascinating. In the light of all of these things, the debt ceiling, the supply chain issue, the shortage of labor, the Federal Reserve moves that they're doing to kind of tighten things up, China's situation with the big property companies having trouble, et cetera, et cetera, et cetera. The market from a high at the beginning of September to a low as of Wednesday this week, it dropped a total intraday total of, by my calculation, about 5.9% on the S&P 500. That's nothing. Honestly, that type of action happens all the time. In the past, in my experience, when you have that kind of news coming out, and especially a debt ceiling, that's getting closer and closer to the edge, you'd be looking at 10, 15, maybe even 20% downturn. So this is one of my points this year that I think is very important. If you watch the price of the market, you get a lot of information about what's happening. And the market is really, really strong. And that overcomes a lot of these other negative pieces. So if you look, certainly the market is up tremendously so far this year. The positives overcome the negative. Yet the negative is what's out there the most. It's what everybody's talking about. The market's still up. And so even though the market came down here in September and a little bit in October, we're still up over June and what have you. I mean, the market is up. And the power of the market is one of the things to focus on. And that could change, right? Things can change. The market could erode and what have you. But again, it didn't fall that much in the face of all of this bad news. That's something to think about because I think that shows very heavy strength and possibly, some more motion to the upside before everything's over here. So I still think that zero interest rates, are driving money into the market because, again, where else are you going to put the market? We're starting to see that really become one of the places where money is going, and that's what we really want. So anyway, that's the summary for the week. I actually think this week was very positive in the end, especially with this debt ceiling, behind us at least temporarily, and I really look forward to seeing what might happen next week.